Haver Analytics, the economic data provider for CNBC and a lot of Wall Street and the economics world, has figured out a way to add up all the state reports on jobless claims, seasonally adjust them, and come up with a proxy that's pretty close to the government's weekly jobless claim report. Not perfect, but here it is. Week of October 11th, 217,000 versus 228, so going down. It shows a decline here on the weekly jobless claims if you use this proxy. When it comes to continuing claims, we're up 1,942,000 versus 1,920,000. Those are two numbers that are both estimated here. Unlike the government, not all states are included. We're missing this week Massachusetts, Tennessee, Nevada, and Arizona. They're imputed. Nevada.
No,
they're imputed because they have not been publicly reported yet. But the numbers overall, they run close to the official data. Take a look at this chart. The government and Haver data differ, but the key is that directionally, you can see here. I don't know why the blue line did not show up, folks.
I see it.
It's not.
It ends.
Something is wrong with the chart system. I'm very sorry, folks. You can take that down. But over time, trust me, they run together along with other private sector jobs data. The later report supports the conclusion that we've had for a while that it's a relatively low fire, low hire economy. So not at the moment any indications that much has changed since the government stopped publishing. You got to always be wary that when they do start publishing, things end up being different. But right now, we're kind of running right around that same 200, 220 level. Goldman Sachs does the same thing, came up with similar numbers.
Yeah, I didn't mean to interrupt that. You know how long that's been my pet peeve. You can actually look at it. There have been major controversies from people in Nevada about people who can't pronounce. They go crazy. And I've seen President Trump say, is it Nevada or Nevada? And he goes, it's Nevada. Of course it's Nevada. And it's not. It's just not.
Well, however you say it, get your darn claims in so that we can put it into the total.
At the end of the day, going forward, just don't do it. Those are more of my pet peeves. That's my single best idea. Let's bring in
Rick,
which I also don't like. Single best, right? Because it's either the best or hey, Rick, Liesman's here. Did you? He had said something totally ridiculous. No, trying to get you guys.
No. Actually, I think his jobless claims numbers would probably be spot on. My real issue is that if that's all you have to look at, and arguably it's one of the better real-time indicators of the labor market. Once again, it doesn't really jive with some of the Fed speak, especially with Chairman Powell this week, so worried about labor. Now, I'm not saying there aren't other metrics that show a much bigger deterioration. I'm just saying that it doesn't seem like it's a fait accompli in terms of writing off the jobs market. And if we look at what's going on with equities, that age-old relationship between stocks and Treasury yields really is coming into play because of something called flight to good collateral. I didn't say flight to safety, even though that's kind of what it is. But it's all about collateral. It's all about bad leverage. It's all about historically tight spreads that led to buying some paper and dealing in credit issues that were far from excellent. And I think it's all coming home to roost to some extent. But I couldn't agree more with everything everybody's been talking about today, trying to compare this to the great credit crisis. I mean, it's like slamming the closet door and saying it's like the San Francisco earthquake. It just isn't in comparison there. But we are at 1-month highs on SOFR. That's the secured overnight funding rate that replaced LIBOR. We have all the futures contracts going wild in Chicago. And I think it's something to pay attention to. Yeah.
Rick, I want to stop you just so everybody understands what you're talking about here. When you talk about highs on SOFR, and I do want you to continue, but I just want people to understand, what we're talking about is a clamor for high-quality collateral. When that number goes up, it's a sign that there's a bit of tightness in the financial market. There is some wariness, some concern. Go ahead and continue. We can understand a higher SOFR is the same thing as, for example, a higher GC repo rate or something like that. It's a sign of a lack of credit or quality collateral out there.
Yeah, a bit of funding issues reaching that you have to pay up when everybody's reaching for the good collateral. And it's really evident. Show that chart again of SOFR. If you look at what happened on September 17th when the Fed cut rates, you saw what it did. It went lower. So this is reversing that to some extent. And I do think that the relationship with stocks is also key. And it gives us the clue that this is nothing like the credit crisis, because to see equities go from down 3 or pre-opening down 350, 360 to up 50. It was up 80 a few seconds ago. And see the Treasury complex, the 10s, were 393. They're now flirting with 4%. And that'll bring me to my final little comment here. Listen, as a technician of the past and a trader of the past, you can never hang on to ideas or notions about the market. You have to be fluid and open-minded. I still believe there's going to be a lot more upward pressure on long-term rates, despite all the issues that would force it lower just because of debt and deficits. The fiscal year ended in September, $1.22 trillion to service the debt. That should basically be enough said right there, but I really still believe that if we don't close above 4% for the week, today's a weekly close, high priority if you're a technician, I would go home long looking for lower rates as well. But I would be very, very trigger happy to reverse because I still think long rates are going to be stubbornly high.
We don't have anything to disagree on. I just want to point out that Chair Powell earlier this week.
I could find something.
You probably could, but let me just make this point here. Chair Powell talked about the idea of ending quantitative tightening in the coming months,
right?
In part because he mentioned some tightening in financial markets.
Exactly.
I don't think this is a critical issue right now. Some of the tightness we saw was around the turn of the quarter, September 30th. There's a clamoring for funds around then, high-quality collateral. Not sure what's happening now. Maybe some of the disruption you could talk about with Leslie Picker may have something to do with it, but it's a bit of a clamor, or not a clamor, it's just a grab for high-quality collateral.